At the end of the day, we want those hard-earned money to work for us. High-yield savings, real estate, retirement accounts, but we're gonna focus on what we can take advantage during these pandemic times, the stock market. In full disclosure, I'm not a licensed professional, nor claim to be one. This is intended to share what worked for me as a beginner investor, although I've been trading in and out since 2007. Also, I'm not receiving any compensation for recommending any platforms, which I use personally, TD Ameritrade, that I've switched from ShareBuilder back in 2007, became Capital One Investing, got bought out by E-Trade. This is my account on TD Ameritrade. As you can see, it has been flat, then COVID hit, which dropped. I took advantage of those times and rebalanced now that it's tripled at least, and the market hasn't recovered yet. Robinhood is also good as they have a very intuitive interface. However, I've been with TD Ameritrade, so I've been sticking with them as they have better tools. Honestly, any platform would work as long as you can perform trading and they've been stable. Robinhood had an issue in the past, but they have been stable for quite some time now. There are two ways to investing, passive and active. It is personal preference which one works best for you. Passive, basically you're in it for the long haul. You spread your buying and selling across time, you limit it. That is the goal for the most part, as quality stocks tend to rise over time. Just like when I bought Microsoft, MSFT is the ticker. They used to be $40 back in 2008. Now, they quadrupled the amount. I've been collecting dividends and at the same time waiting for it to rise if I decide to sell. On the other hand, it's active investing. This involves a lot more time invested in addition to money because you have to constantly monitor, buy and sell. The day trading falls into this category. From time to time, I visit this part of the category, at least to take advantage of what's happening. It's a little bit more predictable. However, statistics show that 80% of day traders lose money within a year. They actually say playing blackjack has more odds of winning than day trading. So between the two, I highly recommend long-term trading, doing a little bit more research than falling into a false promise of quick buck, quick gains overnight, especially for beginners. Even seasoned traders lose money. The thrill of day trading is fun until you get wiped out. Let's get into the strategies, at least the one that worked for me. However, let me start with a reminder first. Invest the money that you're willing to lose. Let's say you invested your $1,000, which is intended for your next car payment, rent, mortgage, or credit card, for stocks that you thought it's gonna grow in a week or two based on speculations or friends bringing it up or so. Then, couple weeks later, the value of the stocks went down from 1,000 to 800, let's say, your portfolio value. Because of bad press, investors thought that it's overpriced that time, and now they downgraded the price of it. And to make things worse, your rent is coming up soon, or your payment that's supposed to be for that $1,000 money is coming up soon. So what's gonna happen? You will then be forced to sell your position. You're absorbing that $200 loss because you needed that money. Because of volatility, the price of the stock sometimes dips a little bit and rises up, but majority of the time and trend, as you look at this graph, it rises up over time. So again, invest in the money that you're willing to lose, or a money that you don't need to tap into or use for the next year or two, because long-term investment is still the best approach, especially for beginners. My first strategy basically is I avoid the misconception of waiting for the lowest. There's no such thing. Basically, I've talked to a couple of my friends, colleagues, even family, try to convince them that invest in the market, invest in the market. This was way back April and May. As you can see, back then was the lowest point in comparison to today's prices. But I kept on hearing from them,
relax bro, I'm waiting for another dip. There's gonna be a dip.
Don't fall for waiting. Look at their charts instead. How is their pricing before COVID, or at least last January, or throughout the years? My second strategy is basically invest into something that you are aware of or familiar with. For me, I initially invested on Microsoft. The majority of the people knows what they do. Back then, 2008, their price, like I mentioned earlier, is below 50. I didn't have to do extensive research because I know they create operating systems for PCs, office suites, software, which I thought it's pretty much being used by a lot of people, so they're gonna be doing well in the future. So I just bought them some shares of Microsoft. Third strategy is avoid the fear of missing out, but do not let opportunities pass. How do you do that? Research. I had that issue actually during the Nikola rise. I bought at a not so good time. Basically, it gets to the best of us. I saw a video about Nikola being announced by one of the news outlets, mainstream media. It could be the next Tesla. So I bought in, which is a big mistake. What I should have done is, when I heard that media, I should have done a research. Basically, have they produced products? How's their earning last year? Little did I know that they're just, I'm not bad-mouthing people, but it looks like they're good in Photoshop.
You've got a button already pre-programmed on your big touch screen. Bam. You want to name that your lights? Name it your lights. You want to make it a coffee maker? Make it a coffee maker. We don't care.
Fourth strategy is use tools. There's just so much information readily available on just a touch of a button using your handy-dandy cell phone. There's no need to go to a public library, even rent an encyclopedia, or Encarta. Some of you guys may know that. There's your trading platform for chart history, price versus earnings ratio or PE ratio, Yahoo Finance, Seeking Alpha, Market Watch for news, and a good old company website for background information about their finance or whatever they do. Does the company have competitive advantage over their competitors? What are they offering? Who are their leaders? What is their performance? Do they have a good track record? Is their pricing low at this time? Is the sector that they're part of low at this time? Just like travel. Travel right now is slow. Anything that revolves around travel, energy, airline stocks are low. Basically, how long will it recover? What is the outlook? Check the news. Never rely on a single source of information. The fifth and my final strategy is dividends. Look out for those dividend-paying companies. Here's an example, AT&T with dividend yield over 6%. Their annualized payout amount on each share is $2.08. Divided by 4, you come up with 52 cents. As you can see, the EX date is July 9. Any investor that has shares before July 9 will be eligible to receive on the payment date, which is 52 cents per share. Let's say 100 shares will be $52. So in summary, a key takeaway is to consider dividend-paying stocks. These companies pay you a portion of their income while you hold and wait for the price of their stock increase. Then you decide whether to sell it or keep it still. So if you're into self-improvement, personal development, and tie them together with motivation, and sometimes geek out on new stuff out there, consider subscribing and let's take life to the next level, baby steps at a time.
It's annoying.